All right, I'm here with Brandon Chapman with Saas Wealth. Brandon, thanks for coming on the show.
Thanks for having me.
I'll cue you up, but basically, this channel is a lot about macroeconomics, real estate. We have the Loonie Hour, which talks about investing and financial markets. But I think the one picture of that pillar that's missing, which is why I wanted to bring you in today, is actually just on the financial planning side. So I always look at it. I'm in real estate, and so when you buy a piece of Vancouver real estate, let's call it, most people's largest asset, $2-3 million in many cases. The first thing you do is get home insurance, right? It's your largest asset. You want to protect that asset. You get home insurance. Most people that are then paying that mortgage or the incomes that they're earning to be able to pay that mortgage don't have insurance on their self or on their business or on their life. And so that's kind of why I want to bring you in today, because I think, again, the conversation is always around investing, buy the S&P 500 ETF, just dollar cost average, buy and hold long term, but nobody ever really talks about, again, putting all the pieces together. So I want to bring you in to have that conversation today. I think in particular, what interests me the most is we're seeing in Canada with this tax regime of where it's going in terms of being able to build and accrue wealth, is you really have to take advantage of the tax shelters that you're given in this country today. We see increased taxations on higher incomes, on wealthier people, increasing capital gains inclusion rates. So all of these things, and say, okay, what is the average person missing? So from your perspective, you work with, a lot of high net worth individuals, a lot of business operators, successful people. What are some of the common mistakes that you've seen these people make unknowingly in many cases?
Yeah, well, first off, thanks for having me on, Steve, and to everyone on your channel, thanks for watching this episode today. What I appreciate most about what you do, Steve, is your boots on the ground and providing real insight into what's happening in Greater Vancouver and across Canada. So kudos to everyone for watching this show and getting your news from other places, from, I would say, sometimes a bit more raw and uncut, which is what you're doing with Loonie Hour. We've had a pretty rough few years here. We had bottom low interest rates, which is great for buying real estate. But now everyone's feeling the pinch because the government's got to get tax revenues from somewhere. So the strategies that are kind of, I'd say, basic that everyone should be following is, of course, own your principal residence, have your TFSA, your RRSP. Once you're using those tax shelters and those benefits, then you can start looking at more advanced planning. So that is going to lead into your corporate structure, how you're structuring your affairs, whether that's operating business or your real estate or holding company. It's not to say that every Canadian and every business owner needs to have a complex corporate structure, but depending on whether you have partners, whether you have a spouse, that's going to lead you down a path as to how you might want to structure your affairs in order to pay less tax.
Yeah, and there's one just to add to that, right? I mean, there's people that, again, follow this channel for the real estate stuff that, maybe they're a T4 income, right? Maybe they're, a medical doctor or, a police officer and they're a T4 income salary, but they might have the desire in the process of building a rental portfolio, a real estate portfolio. And a lot of times you're going to do that through your corporation. You're going to create a corporate structure. So again, kind of structuring and protecting those future incomes, I think is really important. So walk me through a few scenarios that you've kind of seen firsthand of big mistakes.
Yeah, well, there's sort of three camps of people that I like to think about and what I've seen over the years. And I'll give three examples. So first one is the person that doesn't plan at all. So I had a client come to me. They were making over $500,000 a year, no corporation. They already had real estate. They really should have a corporation. So that's a pretty basic one. People generally, if they haven't talked to an accountant or a financial advisor, they're maybe just searching stuff online and they don't feel confident enough in order to set these structures up themselves. So that's, I'd say, square one is if you're earning a high amount of income, you already have your property, and so you've got your mortgage in place, you should probably look at a corporate structure to defer some of that income. There's a process called integration in Canada. So if you're earning income in the corporation, you'll pay the lower tax rate. But then if you flow that out personally, you're still going to end up paying about the same in terms of your overall tax rate. So corporation doesn't remove your ability to pay tax, but it does potentially defer because you can invest within that corporation, only paying that lower tax rate until eventually you flow that money out. Second use case that this actually happened fairly recently. So client was a YouTuber, had done a bunch of research online, had set up a corporate structure that was improper, basically incorporated themselves online.
Wasn't me, by the way.
No, I think you do your due diligence, right? You recognize there's a lot of good information online, but sometimes you got to talk to a human who can provide wisdom from seeing hundreds of cases like yours. This gentleman had already set up, I would say, a relatively complex structure. Actually, had some investments over in the Cayman Islands because he heard that was a better tax move, and he was paying an extraordinary amount in fees and taxes. Potentially less taxes overall, but because he had to do all this stuff himself, he was spending so much time on managing his own corporate structure here and internationally that he ultimately wasn't seeing the same business growth that he was previously. And so after asking a few questions and realizing what the end goal was, it came down to trust. So this guy wasn't that he didn't like accountants and lawyers, he just had to talk to someone who he had a relationship with and trusted. And so probably similar to folks that might be watching your channel, it may take a little while before they trust you enough to have a conversation with you and then work with you on the real estate side. But for some reason, accounting and finance hasn't done as good a job of building online profiles for people. And especially the banks, they generally are just avoiding speaking online, which I think is a disservice to Canadians who are ultimately looking for information online.
Okay, so let's touch on a couple threads on that piece. So number one, regarding banks. So a lot of times our clients will come to us and say, well, I just bought a house. The bank's giving me a mortgage. The bank is then offering me, mortgage insurance. Basically, if I pass away, they will basically pay off my mortgage. And so my spouse can take my house and have no mortgage, which is great, right? I mean, who wants to leave your spouse $1 million mortgage? And so, if you want to walk us through maybe a little bit on that product, some technicalities there, and kind of ultimately what you recommend.
Yeah, mortgage insurance, it can be a tool best used for a family that has no financial literacy, or if somebody has pre-existing conditions that might preclude them from getting their own personal policy. But generally, Canadians will be paying about 3 times for the same amount of coverage with mortgage insurance product than they would pay for an equivalent term insurance product. And the big benefit of owning your own insurance versus using the bank product is you set the beneficiaries. So rather than the bank being the beneficiary of the policy, your family, so your wife, your kids, they could be the beneficiary of the policy. As well, mortgage insurance is generally declining balance. So
right, as you're paying off the mortgage, the balance of the mortgage is obviously declining over time.
But a lot of times you're paying the same rate. And so the bank will roll in the premium into your mortgage. You don't even really see that you're paying it. But if you were to go read the fine print when you first signed up for your mortgage, you may have signed up for this. And the big benefit is that having your own policy versus this mortgage insurance product is that you'll be able to not only set the beneficiaries, but the benefit amount stays the same throughout the life of the policy. And you can maybe have conversion privileges or do other things with it. The mortgage insurance product, it's meant to be a quick sale when the bank is closing on the mortgage. And a lot of times Canadians get suckered into these things without knowing there's better options available.
Yeah. So what you're basically saying is instead of going and getting the bank mortgage insurance, someone can come to someone like yourself, for example, and say, hey, listen, I've got $1 million mortgage. If I pass away, I don't want to leave my wife and kids with $1 million mortgage. I'm the income earner in the home, et cetera, et cetera, et cetera. So I can get a life insurance policy through me for covering myself. So if I pass, there's an immediate payout of $1 million to my wife.
For sure. They would get that benefit amount tax-free as opposed to the bank getting the money. Your family can choose what they want to do with the money. And I think that's a huge value add.
Yeah. And then maybe they don't want to pay off the whole $1 million mortgage. Maybe they want to pay off $500,000 of it and then reinvest the other $500,000 in some sort of portfolio.
Exactly. So everyone's situation is different, but ultimately it gives people options.
Okay. And just on the insurance stuff, I know it's funny having these conversations, right? Because it's like I said to you when we filmed this, we'll keep it short, we'll keep it concise, because I think when we talk about insurance, people's eyes kind of glaze over and it's a little bit boring. But again, I think it's such an important aspect of anyone that's trying to build like real wealth to not protect yourself and protect your family. I think it's actually irresponsible. And so can you just quickly explain the differences between the term insurance and a whole life insurance?
Yeah, term insurance makes sense for 90% of cases. So a young family or a business owner, term insurance is a set benefit amounts. So maybe $1 million over a set period of time. Maybe it's 10 years or 20 years. The rates are going to be lower as you're younger. The costs will go up over time after that benefit period has expired. So the 10-year period or the 20-year period. So term insurance.
So just to clarify, so basically what that means is like, if let's say you do a 20-year term.
Yeah.
So if you pass away in year 19, that's getting paid out, and you know what your premium, you know what your monthly payments or annual payments are going to be.
Exactly. So the term premium amount is set for that period. So let's say $1 million for a 30-year-old male. Let's say it's $50 a month. It's going to stay that same amount for that 10-year period. If you bought a 20-year term, then the rate would stay the same for that 20-year period. Usually the policies will roll into a new policy after that 10 or 20-year period, but the premium amounts are fairly substantial because the insurance company has no idea if you've been smoking or drinking or skydiving for the last 20 years. So they have no idea the true risk. However, that's why some people look at permanent insurance policies, usually not for the whole amount they need. Because when people are young, you just had a daughter. I just had a daughter last year. We've got a high need right now. Like if you got hit by a bus tomorrow and your family didn't have your income, like how would you guys manage?
Yeah. I mean, it's certainly not something you want to like leave your family members behind with, okay, you guys figure out the affairs.
No, exactly. And so the term insurance, ultimately, it's for that young family. It's for that young business owner that wants to offset risk when there's a high amount of need. But it's a temporary need because when the mortgage is paid down, you maybe have more assets. You wouldn't need that full million. Maybe you only need 250 or 500,000. So that's where permanent insurance comes in. And usually it's for a high income earning professional or business owner that's already got the TFSA, the RSP, principal residence, and they want to look, where else can I shelter money tax effectively? Corporately held permanent insurance policies are very valuable. And I'm not like a, be your own banker or a infinite banking type of guy.
Yeah. And there's lots of YouTube videos out on those. I've watched many of them.
Yeah. And I think those are kind of overselling the product. Ultimately, there should be an insurable need. You want to have that permanent life insurance, and then you can develop that cash value in the product. But at the end of the day, this is not a product for everyone. If you don't have a maxed out TFSA, if you don't have a funded RRSP, you don't have your principal residence, a life insurance policy isn't going to make you rich.
Yeah. But it's just an additional way. If you have additional capital or income coming through and you've maxed out those other tax shelters, you're putting it through basically the whole life policy, and you get the tax advantage through that.
Yeah. So you've got the death benefit and the cash value. Term insurance, no cash value. It's simply a protection product. That's like renting insurance. Whole life is owning insurance. There's universal life, which is you can choose the investments. There ultimately is still a cost of the insurance policy for the insurance portion, but you can also grow that cash value tax effectively, which in a corporate structure, very beneficial because you're only paying in BC 11% tax rate, and then you can invest money in that whole life policy within the corporation. Personally, it can still be beneficial, particularly if you're in the top marginal tax rate. If you're paying 53.5% for each additional dollar, you should probably look at this structure to potentially benefit you and your family.
Yeah, there's some nuances on the whole life policy, which we're not going to get into because I think this would turn into an hour-long interview. But basically, essentially, again, that whole life policy, because you own it, you're not renting it like the term insurance. The whole life policy tends to accrue in value over a duration of time, at which point you can actually go back to the insurance companies and some of the banks and basically borrow against the value of that asset. Similar to like how you borrow against your real estate. Hey, my real estate went from $500,000 to $1 million. I'd like to tap in and borrow against that equity. You can actually do that with your whole life policy as well.
For sure. Yeah. And it's never like the solution to everyone's problem, but it is a tool worth evaluating on the tool belt.
Yeah. I mean, we like our leverage. Canadians like our leverage here. Is there anything else though, in terms of when you look at like the big picture? Again, you're talking to a successful business owner, an aspiring business owner that's trying to accrue wealth. Any other programs that you look at? So again, you got your RSP, your TFSA. Again, I think for people that have kids, what kind of tax shelter are you looking at there?
Yeah, like I think our generation, we've got sort of this relative distrust for institutions, government, financial systems. My brother, he has a fishing charter company in Tofino, and he's definitely on that spectrum of people that doesn't necessarily trust the structures that we have in place. The way I look at it is we don't necessarily get to control the way the system works. So we should just understand how the rules work and play within them as best as we can in order to minimize our taxes and minimize our risk. Because like ultimately today we're talking about tax minimization for business owners, professionals, but there's also, what about liability if you get sued? What if you get divorced? What if something happens to your health? Those are all risks that successful business owners and professionals should be evaluating. So one other strategy that some clients have been taking advantage of, it's called a split dollar critical illness insurance, where you'll have the corporation pay for the premium for the policy, and then they'll personally pay for the return of premium. And so some accountants are in favor of this, some aren't. So it's once again not a strategy for everyone, but this can be a way to use your corporate dollars to protect your family and your business, and potentially have money be received personally if there's no claim or payout while that policy is in place.
Walk me through that, like very clean, simple terms, which is, I've got my business, right? So I'm here, I'm running a business, we're earning a nice income. I 6 years from now, I get sick, I can no longer work to the energy and capacity that I used to be able to. So obviously income drops, clientele drops off. And so you're saying there's a product in place that would protect us to some extent against that.
Yeah, there's two. So that one I just spoke about is critical illness, which is a lump sum payout if you get cancer, heart attack, stroke, and there's about 20 other illnesses. The other one I'd say that's more popular and also more likely is called disability insurance. So this is a monthly income replacement. So you're a business owner. Let's say you're making $1 million a year, but if you get sick or hurt, you get paid $0. Now, let's say you got option number 2, where you earn $900,000, but if you get sick or hurt, you get $400,000 a year tax free. Which one would you rather choose?
Yeah, I mean, I think you go with the $900,000. You take a little bit off the top, but you've got that peace of mind, that security.
Exactly. And so ultimately, I think most business owners are so focused on growing their net worth and growing their revenue, they don't think about the potential what ifs. Once you get to a point where you have relative success, you owe it to your family and to your business partners to consider the potential what ifs and cover off those risks.
Yeah. So that's kind of putting all the pieces together, basically. And so if you were to recap that again and again, sort of step 1, your obvious tax shelters, I think everybody in Canada, more or less, well, actually not everybody, most people know, RSP, TFSA, your RESP for your kids.
Yep.
And then you've got your disability insurance, life insurance, critical illness. So those 3.
Yeah. At the end of the day, these are just products. And anybody can go online and search for these products, but everyone's situation is unique. So regardless of where you are across the country, find someone local that you like and trust that you can talk to, that can help guide you on your own financial journey. Because it's not just about products. It's about actually having someone who's got your back that can take care of you when shit hits the fan.
Yeah.
I became a dad a year ago, and I learned a lot from my own father who passed away 2 years ago. He had no will and he had no insurance in place. Not for lack of me trying. I'm obviously in the industry, and it hurts for me to say this because he should have had this stuff organized. But he's a business owner, had assets in South America, assets in Europe, and rather than us thinking fondly to our memories together, we're left as a family to pick up the pieces and be stressed out about what he left behind. And I don't think anybody who has reached any level of success in life would want to put their family through that. And so I think we owe it to the people we love to spend some time to consider, well, what might happen and how do I make sure my family is going to be okay regardless?
Yeah, I know it's one interesting point that you brought up there, because I see it in my business, right? I mean, I think, well, first of all, you're always so busy growing your bottom line and focusing on the business, you kind of forget about the big picture, which is like critical illness, disability, freak accidents. Like, they happen. It's not something you plan for. It's not something you're like, it's almost something you don't want to plan for. It's like, well, I don't even want to think about that. And so I think a lot of people kind of like push it to the side. I see it again in our business where we deal with quite a few estate sales, and sometimes these estate sales, there's no will in place. And then, the family and the estate is kind of left to pick up the pieces, going through this long legal process, incurring massive legal fees, trying to basically find a way to sell the house. And it's always amazed me that, you can go 60, 70, 80 years of in your life and not have like a will set up. Again, I think particularly for like successful business people. So,
well, and a question I always ask is like, you got three options. Do you want to leave stuff to your family, to charity, or to the government? And if you don't do planning, you're basically selecting the government. So if you prefer to have your assets go to people you love, do the planning. Like it might be a bit painful, like time wise and emotionally, to think through some of these things. But at the end of the day, you don't want to be leaving your family out to the wolves and letting the province choose how your assets should be distributed because you didn't do the paperwork.
Yeah. No, I think it's a good place to wrap it up. I appreciate you coming on. Again, we're doing our best to keep insurance, financial planning, estate planning not boring. But I think it's an important conversation, again, for a channel, I think, that is really focused on real estate, accruing wealth, figuring out financial markets, trying to, outbeat the market. But again, kind of losing sight of the bigger picture, which is at the end of the day, it's like, how are you protecting yourself? What kind of assets and legacy are you leaving behind for your family, which I think is what this is all about. And so I think having those proper structures in place is really, really important. And so I want to thank you for coming on the show. For anyone that's listening to this, there's going to be description, show notes of Brandon's information. You can reach out to him, Brandon with Saas Wealth, who can at least have a conversation and kind of set you up and point you in the right direction. Because I think to your point, I mean, and we see this with our own real estate clients, is that everyone's situation is unique and independent, right? It's like, should I buy real estate? Should I build a real estate portfolio? It's like, well, I don't know. Should you? Like, I need to know what your income is, what your goals are. And so there's a lot of pieces, and I'm sure that's kind of the same in your business.
Yeah. Thanks so much for having me on, Steve. I think that these type of conversations are important. And ultimately, you have taken care of so many clients over the years, including myself, with our real estate transactions. And I think it's only reasonable that now, as you're a father, I'm a father, I'm sure many on the line are becoming parents, we think about not only how do we build, but how do we protect. And so looking forward to continuing to build our businesses together, and also making sure our families are taken care of. Thanks for having me on.
It's funny, I'm going to wrap this up, but there's a couple ways to grow a YouTube channel. And one of the ways is to put the thumbnail with the flames all over it and say, don't buy, big stock market crash coming. Implosion, housing market set to crash in 2025. And here I am creating videos about how to set up whole life insurance. But I think it's important, and again, it's not always about watching every subscriber go up. It's really just like, how do I bring value to the community and the audience that I'm trying to build here? And I think this is an important conversation, because every time you and I sit down, I'm learning and saying, well, how do I protect my family? Because that's at the end of the day, like, what are we building this for? And I think it's to hopefully leave something behind for the next generation. And so I think just having those policies and that planning in place to be able to do that. So anyways, thanks for coming on, and I'm sure we'll reconnect again soon.
Looking forward to it.